One of the biggest mistakes I see in the industry is when buyers are told their closing costs, but nobody clearly explains the actual cash to close. Then right before closing, the final number shows up higher than expected and everyone's confused. Makes the buyers question their decision to buy in the first place. I mean, imagine thinking you only need 6K to close a loan and finding out right before closing you actually need 13,000. Not good. And the reason this happens is really simple. Closing costs and cash to close are not the same thing. So today I want to show you the difference and how to think about these the right way. The easiest way to understand this is to think of cash to close like a pie. The entire pie is the amount of money required to close the loan. Now notice I didn't say it's the amount of money you need to bring to the closing. It's just the amount needed to close it. And inside this pie are several slices, but they're grouped into two main categories. The first is down payment and the second is closing costs. And this is where the confusion starts. A lot of people hear closing costs and assume that's the whole pie, but it's not. It's just part of the pie. So let's dig into the two main parts of the pie and make sure we understand them. Now you're gonna need to know this for every mortgage loan you close throughout your life, but it's really easy to understand once somebody actually explains it. So the first section of the pie is your down payment. This is the portion of the purchase price you're contributing towards the home. Most people know what a down payment is, but I want to talk briefly about why we have them. When you pay a down payment, that money doesn't go to the lender. It goes straight to the seller of the property. So if the down payment money goes to the seller and not to the lender, why are there required minimum down payments? It's so the lender knows you're invested in the property itself. That way you're less likely to default on the loan or let the home fall into disrepair, since it's technically a big piggy bank that you live in. Making a down payment means you have some amount of equity in the home from day one. For example, if a home appraises for $100,000 and your down payment is $3,000, you have a 3% or $3,000 equity position in the home on day one. You're invested in it. You can make as large of a down payment as you like, but when buying a home, there are minimum requirements. Depending on the program or the loan, that might be 3%, 3.5%, 5%, 10%, 20%, or really anywhere inside of that range. Now here's an important rule, and this is something that can really cause a lot of confusion for some people. The seller cannot pay your down payment even if you have seller concession. That section has to come from your own funds, gift funds from friends or family, or a down payment assistance program. And the second main section of the pie is closing costs. These are the costs involved in completing the mortgage and the transaction. There are dozens of people involved in making a mortgage loan happen, and they all have to get paid for their time, effort, and expertise. Closing costs make sure that happens, and they typically include fees like lender fees, like origination and underwriting, title and escrow fees for handling the closing process, verifying ownership of the property, ensuring the deed and the mortgage record with the county, the appraisal, which is required by the lender to ensure the property is worth at least the amount they're lending you, or prepaid taxes and insurance, which are also required by the lender to make sure their investment is protected. Now, these are just some examples of the costs and fees people are referring to when they use the term closing costs. All of these little fees are their own slice of the cash to close pie, and they're part of the bigger closing cost section of that pie. But remember, closing costs is just one section of the pie. It does not include the down payment. Also, one important thing to call out, closing costs don't have anything to do with the real estate agent compensation. Those funds are covered separately through a seller or buyer agreement you sign with your realtor. Now, here's where things get interesting. Different sections of the pie can be paid by different people. For example, the closing cost section can often be paid by you as an out-of-pocket expense, or if you're doing a refinance, you can actually finance those fees into the loan. They can be paid by the seller in the form of concessions negotiated through your realtor. They can be paid as a lender credit for taking a higher interest rate than you qualify for, or gift funds, money from friends or family. Quick caveat, please talk to your lender before you accept any gift funds from anyone, because it can kill a deal if you do it the wrong way. But now the down payment section is different. The seller cannot pay for the down payment through concessions. It has to come from your funds, gift funds, or a down payment assistance program. So when someone says, don't worry, the seller's covering closing costs, that does not mean the entire pie disappears. It just means one section has been covered, that closing cost section. You still need to cover the other section, the down payment. And there's also something else that most buyers don't realize. This may be little in the weeds if you're just starting to think about buying, but it is important if you're planning to rely on seller concessions. There are limits on how much the seller can contribute through concessions. So those limits depend on the loan program and the size of your down payment. For example, some loans allow the seller to contribute 3%, while others allow them to contribute 6% or even more, but there are caps. So even if a seller wanted to pay everything, sometimes the loan guidelines simply don't allow it. This is something you'll want to discuss closely with both your loan officer and your realtor if you're planning on building a purchase off of seller concessions. Now, the reason buyers get surprised when they hear one number early in the process and something else later on. Someone says your closing costs will be around this amount. But the real question that we need to answer is, what is my total cash to close going to be? That's the money you need to bring to the table. That includes everything that you're going to be responsible for. Now, if you want help visualizing what this pie might actually look like for you, I built a simple cash to close calculator, and you can download it using the link in the description below. It walks through the different pieces so you can make sure that you have a clear understanding of exactly how much money you're going to need to bring to the table and how much you can ask for from a seller. And if you'd like help walking through a real world scenario, you're always welcome to schedule a call with the link in the description below. My goal is always to help you understand the process clearly so you can move forward with confidence.